Hey everyone, I hope you guys are all staying safe out there. I wanted to chime in with a bit of a market update. A lot of people have been asking, hey Serge, can you give us a market update here today? So obviously happy to do so. Some of the things that we are seeing and some of the things, of course, that we are doing as well with our clients. So let's quickly just go right to the chart, and I wanted to bring up an important point here, and you know, to some extent this is largely a perspective building, and then we're going to quickly into some ideas. So what I've crafted here is a chart of the S&P 500. I think that's the blue line. Then you have high yield, which represents basically junk bonds or lower rated bond credit, which is the teal line. That's this one here. And then in the in orange is the Nasdaq 100. And for some of you guys that have been following us, maybe you're a paying client. If you're just following us on YouTube or Instagram or Twitter, you know that we've been pounding a table on the Nasdaq 100 large cap tech. Ultimately, you know, could see a lot more downside, and we've seen some of that mean reversion. But here is something I want to just point out, and I think this is really important for perspective. We're hearing still plenty of people, a lot less than 2 weeks ago, when after the initial pullback in stocks, we had a lot of people say, oh, this is a buying opportunity, when the market was off like 3-4% off the highs. Obviously now we're down with 33% in S&P terms. But what's different here about this situation now than I think for a lot of the past 5 to 10 years, different little mini crises we had, is that we're not having a credit problem, even though the government's here to backstop. You know, the business cycle is very much later in the cycle, so the credit problem is much larger. So junk bonds are telling us something quite serious here. We will see very sharp bounces, by the way, in the short term, and I mentioned this earlier this week in equities and risk assets in general, even in high yield. But I think within the context of a bear market and most likely, in my opinion, at this point, some sort of recessionary reading. But if you look at the teal line here, that's the high yield index, and you can see it is much more further down, and I guess in relative terms on the chart here, than the equity is, and that is not totally atypical. It's just that, again, where we are in the cycle. So this is one of the things that keeps me, you know, very reserved in terms of putting a lot of long-term capital to work, as opposed to what we are doing is putting little pieces out there, you know, literally a fifth of a position, you know, buying things here and there, indices, and even in some individual stocks. I'll go through one or two of them here in a minute. But the other thing I want to point out is, if you might see the orange line here is less oversold, or is less down, if you will, than the blue line, which is the S&P 500, and that's the Nasdaq 100. And so I wanted to bring you guys this chart, just quickly having a look at the Nasdaq 100. Well, actually, let's first look at the S&P, just so you guys can see what I'm talking about. So again, if you've been following us here on these video channels, you heard me, you know, talk about this and draw these lines like a maniac for the past few months. And I said, listen, it's not sustainable. We talked about, let me draw the lines again. We talked about this move up here, complete insanity. We overshot, and now we're arguably undershooting, although I do think we could see more downside ultimately after some very sharp bounces. But this is typical what happens, and again, I hope you guys heeded that call and we're well prepared. We know certainly the paying clients for the most part were. So this is what's happening in the S&P. But if you look at the Nasdaq 100, you know, we're still having, it's a bit of a different channel, but the long-term picture, you know, we still have more potential downside. So through this lens, this is purely technical, but it also still tells me that a lot of people are still holding on to things like Apple and Microsoft, which are good companies in their own right. But, you know, when you get more forced liquidation, and I think we have more to go through the lens of the next weeks, months, potentially, I would not at all be surprised if the Nasdaq 100 has another, you know, 10, 15, 20% of downside. So I just want to give you this for perspective. It's not to scare anyone, just what we're seeing. We're not saying we're going to be right, but it to me looks like there's still a pretty good chance of that happening. On the weekly MACD chart, it's just one indicator. We could still basically have more downside there. So the other thing I want to point out, and this really goes in this along the same lines, is we have, I've mentioned this to our paying clients now for the past, I think, 3 years. And what I've been saying to them is that, listen, we have a generation of investors out there, professional investors even on Wall Street. You know, if you go back 10 years, the guy that's now 33 years old, he was 22 when he started his career. If you go back 10 years from now, that was the beginning of the bull market in 2009. So a lot of people on Wall Street that are now in their low 30s, you know, that kind of thing, maybe late 20s, they've never seen a bear market. And even worse, some of their favorite stocks, and I'm not trying to ridicule these people, by the way, it's just a fact, right? They've never seen a bear market. There hasn't been one in the past 10 years. We're now probably seeing one, and some of their favorite stocks they've grown up with, so to speak, like a Facebook, for example, has never actually seen a real earnings recession, right? So they've never seen a cycle in some of their favorite stocks, not to mention a cycle anywhere, right? So this is one of the reasons that I think a name like Facebook can easily get back down into the low 120s. Not tomorrow. I think there are very sharp bounces to be had in the meantime, but you will see that some of these companies are not recession proof. Even a Google, which I like as a company, I'm not quite sure they're recession proof, and there may be potential other headwinds. So there's a lot of things here that can still unfold themselves over the course of the next few months. We're still very early innings. We have to first chew through this and get the lockdown down and everything that's happening. But I just thought I would chime in on this. Again, it's not to fearmonger, but usually these kinds of these recessionary periods, which I think we're heading into, we're probably already in a technical recession. They don't resolve themselves in a V-shaped manner where the Fed just comes in and everything is good again. I think this is different. The Fed can certainly help. The government in general can help, but we will see waves of things as they unfold themselves. Right? Lehman didn't collapse at the very beginning of when the crisis started. It took a while. Right? It's the same thing here. So you will see news, you know, get a little better, and then it'll get worse, maybe a little better, and then ultimately at some point when it's all done, you know, finished and done, maybe it takes another 3-6 months till we reach an all-time low, an ultimate low, I should say. I don't know in equities, but we'll have to measure this, and it doesn't resolve itself right away. So anyway, folks, I hope this was helpful. Please give us a thumbs up, like, subscribe to the channel, share this, spread the word, and any comments, of course, let us know down below. With that, stay safe, and I'll talk to you soon.